Oke, Assalamualaikum warahmatullahi wabarakatuh. My name is Ratriza Intan Anini. With the last two digits in the end is 114. So here I'm going to explain about the chapter 13. First material is about to describe the nature, valuation, and reporting of current liabilities. First, about the nature of liabilities. So the nature of liability represents a financial obligation that a company must resolve to continue its standard business operation. EISP defines a liability by three essential characteristics. First is present obligation. Present obligation is a current duty or responsibility of the entity. Second one is transfer of economic resource. It requires the future transfer of cash, goods, and services. And then the third characteristic is past event. Is the obligation was result from a past transaction or event. Okay, now to the next slide. We are going to discuss about the division of liabilities. So liabilities are divided into two main categories based on their payment dates. First category is current liabilities. So current liabilities is report if the obligation is expected to be settled within the company normal operation cycle or within 12 months after the reporting dates. Then the second category is non-current liabilities. It's obligation with a more distant date that do not claim current operational research. Okay, now let's move again to the next material. It's about valuation. So there's a two-way to do valuation for current liabilities. So first is theoretical rule. So in here, liability should be measured at the present value of the future cash unless regard to settle them. And then the second way to valuation, the current liabilities is with practical exception because the time period involved is short or frequently less than 1 year. So the difference between present value and maturity value is immaterial. So therefore, current liabilities are recorded and reported at their full maturity value. Okay, now let's discuss about the reporting of current liabilities. So for the first one, current liabilities we are going to discuss is about notes payable. So there's a two type in here. First is interest bearing notes, and the second one is the zero interest bearing notes. We're going to discuss about the interest bearing note first. It's a state interest rate. So when we borrow the money, we record cash as debit and notes payable as credit. And then when we record interest at the end of the month, we record interest expense in debit and interest payable in credit. And then when we pay back at the end, we record not payable as debit, interest payable as debit, and cash as credit. Okay, and then the second one of notes payable is zero interest per unit. So it's the interest that is paid into the final payment. So when we borrow the money, we record cash in debit and notes payable in credit. And then when we record the interest at the end of the month, we record interest expense in debit and notes payable in credit. Then when we pay back at the end, we record notes payable in debit and cash in credit. Okay, so for the second current liabilities that we are going to discuss how to report it is unearned revenue. So this is the revenue that getting paid before we do the work. So for the report, when the customer pay us in advance, we record cash in debit and the unearned revenue in credit. And then when we finally deliver the goods or we finally do the work, we record unearned revenue in debit and sales revenue in credit. Now let's move again to the next slide. Next current liabilities we are going to discuss is sales tax payable. So we collect a tax for the government. So when we make a sale and collect tax, we record cash and debit, sales revenue and credit, and sales tax payable and credit. Then for the next or last current liabilities we are going to discuss is employee-related liabilities, or we usually call it payroll. So when we record payroll, we record weeks and salary expense as debit, withholding tax payable in credit, social security tax payable in credit, and cash or weeks payable are also in credit. So maybe that's, and the next module will be explained by my friends.
For the next part, we are going to talk about the accounting for different types of provision. So, what is provision first? It is a liability whose amount or payment date is uncertain, and it may be classified as current or non current depending on when it is expected to be paid. And then about the recognition of a provision. So there are three conditions for a company recognizes a provision. So the first is the present obligation. So the company has a present obligation because of a past events. And the second is probable. It is probable that the company will need to use resources such as cash to settle the obligation. And the last condition is the amount of obligation can be reliably estimated. And then, how about the measurement of provisions? So, the provision should be measured at the best estimated of amount needed to settle the obligation. What is best estimate? Best estimate means the amount that company would reasonably expect to pay to settle the obligation at the reporting date. For example, Toyota warranties, like Toyota estimates future warranty costs based on past experience and the probability of repairs. Or another example is Carrefour customer refunds. Carrefour estimates the amount of customer refunds and may use the average of midpoint of expected refunds amount. And then uh, we move to the types of provisions. First, the lawsuits. Lawsuits are litigation. It refers to the legal cases or lawsuits involving a company. So, if the company believes it will probably lose the case and can estimate the amount of the loss, it must recognize a provision. And the second type is warranties. Warranty is a promise by a company uh, to repair or replace defective products, because some products are expected to fail and company estimate future warranty costs and record the provision when the products are sold. And the third type is consideration payable. The consideration payable refers to the amount a company expects to return or pay to the customer after the sale, such as rebates, coupons, discounts, loyalty rewards, or refunds. And that's all from me. The next part will be explained by my friend.
So let's continue to the environmental provisions. This is a liabilities recorded for the estimated cost to clean up or restore the environment due to a company's operation. So for the accounting recognition, it has three. The first one is obligating events, which is this typically involve the legal requirement to decommission nuclear facility, dismantle offshore oil rigs, or restore mining lands and landfills at the end of their useful life. So for the second is measurement. It's based on the estimated future cost to settle them at fair value. When an active market isn't available to find this price, companies use similar market data or present value techniques instead. For the last, it's recognition and allocation. So when a company faces an environmental cleanup cost, it adds that amount to both the value of the asset and its recorded liabilities. And that cost is then slowly turned into expense over the year the asset is used. For the next is onerous contract provisions. So it's a contract in which the unavoidable cost of meeting the obligations under the contract exceed the economic benefits expected to be received from it. For an example, is like a loss recognized on unfavorable non-cancelable purchase commitment related to inventory items. So this is the some example of some art sports. So he moved to a new factory, but they are stuck in non-cancelable 3-year lease on their old facility, so they cannot sublet it to anyone else, meaning they have to pay for a building they aren't using. For the remaining cost is 200,000 euro. So it must immediately recognize the least net cost of getting out of it, which is lower of the cost to fulfill the contract or the remaining rent, and the penalty to break the contract. For the journal entry is loss on lease contract and lease contract liability for 200,000 euro. So now let's move to the restructuring provision. So it's a program planned and controlled by management that materially changes either the scope of a business or the way the business is conducted, such as a closing division, selling line of business, or cutting a layer of management. So for the example is like sales of a line business, change in management structures such as eliminating layer of management or a closure of operation in a country. So only direct incremental costs associated with the restructuring may be included in the restructuring provision. These are costs that may and may not be included in restructuring provision. For the costs included or direct incremental is employee termination costs related directly to the restructuring, and the second is contract termination costs such as lease termination penalty, and the last is onerous contract provisions. And for the cost excluded, it's an investment in a new system. For the second is lower utilization of facilities, cost of training or relocating staff, cost of moving assets or operating, administration or marketing costs, allocation of company overhead, and the last is expected future operating costs or expected operating losses unless they relate to an onerous contract. For the last is self-insurance. So despite the name, self-insurance is not insurance, it is risk assumption. It refers to a company's decision to not buy an insurance policy and instead bear any future losses like fire, flood, or accident or other accident out of its own pocket. So, and it is not a provision because under IFRS, a provision requires a present obligation resulting from a past event. So a company cannot have a legal or constructive obligation to itself, therefore it cannot record a liability or an expense for a hypothetical future disaster, even if you can estimate the odds of it happening with high certainty. Decreases in asset value or expenses are only recorded after an actual emergency happens.
Hello everyone. My name is Sakidla Firmansyah with class 3-digit NBM 186. Now I'm gonna explain about the third learning objective of chapter 13, which is accounting for loss and gain contingency. First, we take a look about the loss contingency. Loss contingency liabilities, it's a potential obligation that are not yet certain. According to IFRS, contingent liabilities are not recognized in a financial statement, but they fall into three categories. First is a possible obligation. It's not yet confirmed whether the company truly has an obligation. Second, a present obligation but not probable. So the obligation exists, but the likelihood of payment is low. For example, like less than 50%. Third, a present application where a reliable estimate cannot be made. So the application exists, but the company cannot reasonably estimate the amount. So in short, these are not recorded as a liability yet. Next is the contingent liability guideline. So first, if the outcome is virtually certain, like at least 90% probability, the company record it as a liability or provision. If it is probable, like 51 until 89 probability, the company also record it as a liability. But when it is possible but not probable, like 5% until 50% probability, no liability is recorded, but the disclosure in the note is required. And then if it is remote, less than 50% probability, there is no disclosure is needed. So for possible contingency, disclosure must include a brief description of the nature, an estimate of the financial effect, uncertainties about timing or amount, and the possibility of any reimbursement. So these rules ensure that the financial statement do not mislead investor and creditor. Next is the contingent asset or gain contingency. Contingent asset or potential gain is a typical example. There is a typical example. So it is a possible asset from past event whose existence will be confirmed by uncertain future event, not only when the company's control. So there is a typical example of gain contingency, like possible receipt from gift or donation, potential tax refund from dispute, or pending lawsuit that the company is likely to win. So the rules for contingent asset is stricter than for liability. Why? It's because accounting is conservative, that we should not be overly optimistic about reporting uncertain gains. So there is accounting treatment for the gain contingency. Contingent assets are not recognized on the statement of financial position because they may be disclosed in the note only even on inflow of economic benefit is more likely than not. For example, more than 50%. So they are recognized as an asset only when realization is virtually certain, like more than or 90%. At that point, they are no longer contingent. So there is an important rules in the gain contingency. So disclosure must avoid giving misleading indication that the income is certain. So that's all for my presentation. The next material will be presented by my friend.
In this chapter is indicate how to present and analyze liability related information. So, presentation of current liabilities. In practice, current liabilities are usually recorded and reported in financial statement at their full maturity value. The current liabilities accounts are commonly presented after non-current liabilities in the statement of financial position. Detailed and supplemental information concerning current liabilities should be sufficient to meet the requirement of full disclosure. For example, like Wilmar International Limited that we have here, companies should clearly identify secure liabilities as well as indicate the related asset pledged as collateral. If the due date of any liability can be extended, a company should disclose the detail. So the analysis of current liabilities, so the distinction between current and non-current liabilities is important to provide information about the liquidity of the company. So the first method is the current ratio. The current ratio is a ratio of total current asset and current liabilities. So current ratio is equal current asset divided by current liabilities. The ratio is frequently expressed as a coverage of so many times. Sometimes it's called the working capital ratio because working capital is the excess of current asset over current liabilities. And the next one is the asset test ratio. Many analysts favor an asset test or quick ratio that relates total current liabilities to cash, short-term investment, and receivable. So the asset test ratio is equal cash plus short-term investment plus net receivable divided by current liabilities. So in total it could be like this. So current ratio, the current asset around 25 million divided by current liabilities 12 million, it's equal 2.02 times. Yet the asset test ratio, the cash plus short-term investment and net receivable divided by liabilities, which in total 16 million divided by 12 million is equal 1.27 times.